Good morning, and thank you for having me here today. I certainly appreciate the opportunity to be here before you. My last trip for work outside the U.S. was when I was head of bank supervision at the FDIC, working on Basel Committee issues with other bank supervisors, and so far, this trip has been a lot more relaxing. But today, I'm going to provide you with a general update on the U.S. housing market, and I'll discuss at a very high level one of the key programs that both Fannie Mae and Freddie Mac are working on that I thought was important to discuss today. And I am going to leave some time for questions at the end, and I'll try to keep my remarks brief. Now, the housing crisis took place over 10 years ago, and while it's well functioning now, the level of private sector participation is not the same. Today, the U.S. government backs approximately 90% of mortgage-backed securities, and Fannie Mae and Freddie Mac represent a big part of that. Together, they support over $5 trillion in mortgage loans and guarantees. They're the largest issuers of conventional MBS, and yet they remain under government control. If you recall, over 10 years ago, there were some universal assumptions that proved to be false. And I'm going to take personal privilege and insert my role 10 years ago as head of supervision, and I'm going to marry it with my current role with where I'm the deputy in charge of housing today. So back then, the notion that financial institutions would effectively self-regulate and that sophisticated mathematical models could accurately evaluate all risk. There was a notion that if you didn't have balance sheet risk, you could originate and distribute almost anything through securitization. We had wide gaps in our regulatory processes. We had an unregulated and widely dispersed shadow banking industry. And investors, of course, bought rated securities that were backed by unsustainable loans. There was easy credit. People bought into the idea that home prices would continue to increase, and they took out loans that were poorly underwritten. Many borrowers ended up with loans with terms they did not understand and loans they ultimately ended up not being able to afford. And as a result of the financial crisis, our Congress enacted a number of reforms, most notably the Dodd-Frank Act and the Housing and Economic Recovery Act called HERA. Now, HERA led to the creation of my agency, FHFA, which supervises Fannie Mae, Freddie Mac, and the federal home loan banking system. HERA consolidated supervision of the government-sponsored enterprises within FHFA, and it provided us with supervisory authorities on par with those of the other federal safety and soundness regulators. And this turned out to be just in time because we used our newly acquired supervisory powers to place Fannie and Freddie into conservatorship. And today, we continue to operate in a dual role, both as conservator and regulator of Fannie Mae and Freddie Mac. Certainly, we've seen a tremendous recovery in the housing market since the crisis. In early 2015, housing prices started to generally come back, and they've now surpassed their levels from early 2008. There's been a steady rise in house prices across most of the United States. However, this is partially due to a relatively small inventory of homes for sale. Mortgage delinquency rates are low, and although they're not at historically low levels, seriously delinquency rates, and these are loans that are 90 days or more past due, have generally been falling since 2010. We are, however, seeing a slight uptick in delinquencies as a result of the impact of the 3 hurricanes that hit the U.S. and Puerto Rico last year. In terms of foreclosure prevention, we now have some very effective mortgage modification programs that benefit the borrower, the investor, and the servicer of the loans when borrowers become delinquent. We've got stronger underwriting standards, and there are better mortgage products. Loans of the past are no longer allowed to be purchased by Fannie Mae and Freddie Mac, And there are substantial capital requirements for banks that make and retain loans that do not comply with the QM requirements, which is known as our ability to repay rule. Fannie and Freddie are also subject to annual stress tests as mandated by Dodd-Frank. And this, of course, is quite useful because they determine the financial impact on these institutions under different stressful economic scenarios. We, like the other regulators, publish the results of the Fannie-Freddie stress tests every year. Affordability is a growing challenge, especially in high-cost urban areas in the states. Rising house prices, rising interest rates, and a shortage of inventory are all factors contributing to this challenge. Again, the shortage of inventory is the largest factor from the supply side. Now, even though Fannie Mae and Freddie Mac have been purchasing high credit quality loans in the past decade, we've been working with them to further transfer some of their credit risk to the private sector. And this would have the benefit of lowering the risk to taxpayers while the enterprises are in conservatorship, and also increasing private sector participation in the mortgage market. The new credit risk transfer programs go beyond transferring risk to the mortgage insurance that's already required by law, and it facilitated the development of a brand new market since the first transactions took place in 2013. Through the end of 2017, the enterprises, through the credit risk transfer or CRT programs, have transferred a portion of credit risk on about $2.1 trillion of UPB with a combined risk in force, which are the maximum losses transferred, of about $69 billion. The most predominant CRT transaction is a structured debt issuance, which accounted for about 69% of their credit risk transfer activities last year. In the past year, the enterprises also announced plans for a proposed new CRT structure, which would evolve the current debt issuance structure to a bankruptcy remote trust with REMIC-eligible loans. The new structure addresses the timing mismatch in accounting for the recognition of credit loss and the credit risk transfer benefit, and it also eliminates some of the issues with a debt issuance structure. At the same time, by qualifying as a REMIC, the proposed structure should be more attractive to domestic REITs and non-U.S. investors, thereby hopefully expanding investor participation in the CRT market. This market is relatively new, and it hasn't been tested in a down cycle yet, but it doesn't replace the good risk management practices that we still expect Fannie and Freddie to have in place, nor does it replace mortgage insurance. Still, CRT has become a standard part of the business in the post-crisis world, and as I turn to the topic of housing finance reform, CRT has also been introduced as a component of many of the proposals that we've seen as well. Now, since the financial crisis, there have been many legislative efforts introduced to fundamentally change how Fannie Mae and Freddie Mac operate. There have been proposals to shut down the enterprises. There have been proposals to provide recognition of the importance of the enterprises to the single-family mortgage market. There have been proposals to reconstitute Fannie and Freddie, modify them, or replace them in a way to produce the same kind of support they currently provide for homeowners. There have been proposals by Republicans. There have been proposals from Democrats. There have been even proposals that have bipartisan support, which today is pretty rare. And there have also been proposals and principles for reform for trade organizations and academicians. Even my neighbor has thoughts on what we should do with Fannie Mae and Freddie Mac. You'd think that with so many ideas to choose from, we by now would have selected a winner, but yet we have not. There could be a reluctance to change anything because right now we're not in a crisis. In fact, there are many ways in which both the federal government in the U.S. and consumers benefit from this current structure. And by the current structure, I mean retaining Fannie and Freddie in conservatorship. From a revenue perspective, the Temporary Payroll Tax Cut Continuation Act of 2011 added 10 basis points to the guarantee fee charged by the enterprises on every loan they purchase. And those funds are allocated to the U.S. Treasury Department, and this will take place through 2022. In addition, each quarter, any profits earned by Fannie Mae and Freddie Mac are swept to the Treasury Department. Both of these ongoing revenue sources are available to be used for a variety of federal programs and initiatives. Though Fannie Mae, Freddie Mac, as well as Ginnie Mae, FHA, and VA, the housing market in the United States has a tremendous amount of support from the federal government, both directly and indirectly. This support leads to relatively low rates for standard 30-year fixed-rate single-family mortgages, as well as some stability in house prices. Under some of the reform proposals, there would be less government backing of the mortgage market, which could make some consumers and investors nervous, leading to unknown effects on prices and interest rates. But mostly all of the reform proposals would provide government support differently than is being provided for today. Some proposals entail guaranteeing the securities themselves as opposed to the issuer of the MBS. Or there are some proposals that remove the enterprise's affordable housing goals and duty to serve requirements, and they put special funds in place to provide subsidies instead. Every time someone proposes a new way to structure even part of the market, there's going to be winners and losers, and it's extremely difficult to determine the full impact of some of these proposals. So you can see why some of the reform proposals out there, we just haven't found the winner yet. And additionally, Congress would have to vote and agree on how to move forward. On the other hand, there is risk associated with the federal government continuing to play such a large role in this market. There really is not substantive private capital in our system. Compared to 15 years ago, the support and implicit backing of the federal government is much larger. In general, we try to minimize government participation in the business, but the current system does not do that. You can't get more involved in the mortgage market than having the government own conservatorships with over $5 trillion in mortgage assets. There are uncertainties that exist for the market as long as the enterprises remain in conservatorship. We've heard policymakers from all sides say that this conservatorship was not designed to last forever, but yet they've gone on for a long time already. I'm going to make a non-newsworthy statement on the prospect of housing finance reform in the United States, and that would be, I'll believe it when I see it, and that's my personal opinion. There have been a number of proposals since the crisis that have momentum, and I'm not sure what happens to the momentum, but the conservatorships, if Fannie and Freddie were children, they'd be in the 4th or 5th grade about right now. They have been in conservatorship for more than 10 years, and again, you can't give any prediction on how long that is going to last or if reform would take place. And if anybody ever got up here and told you they knew the answers to that, I would really call them out on it because nobody knows. Certainly, if we had picked a winner, this would have been a very different speech. And the reason I raised the issue of Fannie and Freddie and conservatorships is because I believe that until we resolve that issue, the discussion on covered bonds in the United States will be blurred by the uncertainty of what happens to Fannie Mae and Freddie Mac and the housing markets, which is 25% of our GDP. On that note, I certainly would like to thank you for having me here today and look forward to your questions.